Most people don't have a deal problem. They have an underwriting problem. They look at a listing, they see a big SDE, they see a story, and they fall in love. Today, I'm going to show you how to underwrite a deal fast, the way a serious buyer and a lender think. Clean, no fairy dust. If you want the exact template, comment SBA and I will send it to you. Let's do it. Step 1. What is the true repeatable cash flow? Not the broker's number, not the seller's story, the real number. So I start with the P&L. Then I list the add backs. And here's the rule. If you can't prove the add back, it's not an add back. Owner perks, personal expenses, one-time cost, that's fine. But show me the receipts. Show me the pattern. Show me it's not recurring. Also, owner dependency matters. If the owner is the rainmaker, you need a replacement cost. You don't just add back the owner's salary and pretend you're free money. So I normalize the earnings and I get to a number I trust. Call it normalized SDE. If you can't prove the add back, it's not an add back. Next, price sanity. Here's the truth. A multiple is not a fact. A multiple is a summary of risk. So I ask, what kind of risk is this business? I look at customer concentration, recurrent versus project revenue, gross margin stability, and how complex operations are, and how dependent it is on the owner. Then I decide if the multiple makes sense. And I want you to hear this. If the story requires you to be a hero, it's not a deal, it's a gamble. Now we do the truth serum. Debt service. Because SBA is not about can I buy it, it's can the business carry the payment. So we take purchase price, down payment, loan amount, rate assumption, term assumption, and we estimate the monthly payment. Then we compare that payment to normalized cash flow. And I'm looking for a cushion, not break even, not barely, a cushion. Because after you close, stuff breaks, things happen, people leave, costs surprise you. And if you're too tight, you're dead. Debt service is your friend. If the payment is too high and the deal is too tight, it's not a deal, it's a job. Next, total cash required. This is where first-time buyers get punched. The down payment is not the full cash needed. You also have closing fees, legal fees, and a working capital reality. That's when I ask, how fast do your customers pay? How fast do we pay payroll? How fast do vendors get paid? If cash timing is tight, meaning you have to pay your employees and for materials right away, and then you only get paid 90 days later, then you need a larger buffer. Otherwise, the minute you close, you're immediately stressed out. Now the decision. Here's my simple go, no go rule. If I cannot clearly see stable operations without the seller, debt service with cushion, and at least 2 real growth levers, I pass. Not because I'm negative, because I'm disciplined. And that discipline is how you survive long enough to win. If you want my underwriting template, comment SBA and I'll send it. And if you want me to underwrite your deal live, join the deal room this week, submit your numbers, and I'll show you what's missing and what matters. If you're buying a business in the next 12 months and want a structured process, apply for the Acquisition Collective. On the next video, I'm going to explain working capital and the clause that saves you 6 figures.